You can see the big loser we thought was going to be the application layer, largely software as a service. Now, if there's something wrong with this chart, you can see it is in our projection for software as a service going forward on the top there, 20% plus. It's not going to be anything like that. In fact, we do believe that software as a service is becoming a victim of this AI revolution. There will be consolidators and software as a service providers who do survive this route. They will consolidate the market. But we underestimated ourselves. We were saying that SaaS was going to lose share. We didn't realize how much, how soon. And that gives you a sense of how quickly this revolution is happening. 142% for Palantir, U.S. commercial, in 1 quarter. We didn't expect that either. In fact, our CAGR, our compound annual rate of revenue growth assumption, which we thought was enormous at the time, for the next 5 years for Palantir itself, is 55%. That could be wrong too. Maybe it's too low. So here we are. Okay, next, what about all of these capital spending announcements from the hyperscalers, especially? This is unnerving the Mag 6 or investors holding the Mag 6. These investors, many of them benchmark sensitive. What does that mean? For people who don't understand what that means, the market since the tech and telecom bust, and so that was the early 2000s, and the 08-09 meltdown has become much more quantitatively driven, which means that many portfolios are guided heavily by the indexes out there. Now, to give you a sense of that, Amazon and NVIDIA in the NASDAQ 100 are in the 3 to 4% range in terms of the holdings. And what benchmark sensitivity means is portfolio managers will say, okay, I am betting against, let's just say NVIDIA for argument's sake. NVIDIA, I think, is at a 3.4% position in the NASDAQ 100. And so those portfolio managers will take their position down from, maybe they were optimistic on NVIDIA and they were at 3.8. Well, they'll take it down to 3. And to them, that's betting against NVIDIA. And to them, that's also taking a big risk because they're being compared against other managers who are doing much the same thing. As you know, ARK Invest doesn't think that way at all. We are focused on the future, and we're very focused on pure plays. Not that, I mean, we do hold both NVIDIA and Meta in our funds, but for the most part, certainly in our flagship strategy, we're well below that weight, well below, in the 1 to 1.5% range. Just to give you an example of how portfolio management has evolved over the years in the traditional asset management world. So I think that the shareholder base holding the Mag 6, they have gotten so used to cash hoards and massive free cash flow generation that this is a big shock to them, seeing these hyperscalers take their capital spending budgets up 100% in 1 year. I think Amazon announced it would go from roughly 90 billion to 180 billion next year, or this year, 2026. That's shocking to people. And we're seeing some of the Mag 6 raising debt even. That has been anathema to this group. So we do think we're seeing a shareholder turnover, not massive because of what I just described about benchmarks. But we don't think necessarily that they are doing the wrong things, meaning the hyperscalers. We think Google is doing the right thing. And all of the Amazon, all of this spending, we think is the right thing to do. But this is not what traditional portfolio managers who are benchmark sensitive are used to grappling with. We grapple with it all the time. But here you can see what we put in our Big Ideas 2026. You can see, and what we're trying to illustrate here is investment in data center systems. Now, I know you've probably seen the $650 billion capital spending boom that newspapers are highlighting. That includes much more than data center systems, so just want to make that clear. So you can see here that data center system spending growth was really mid-single digits at an annualized rate for many years, and it kind of stayed in the $100 to $200 billion range until the ChatGPT moment. And since then, you've seen a compound annual rate of growth at 29%. I think with the announcements today, 100% in 1 year, we're moving into overdrive. Now, you can see from our forecast that we've been expecting a 30% compound annual rate of increases since 23. And I think if we were to push this forward to 25 now and do a 5-year CAGR, it would be in the 25% range. So these recent announcements certainly are proving this forecast right. And then you can see, just to throw in another perspective here, we also see that the chip market is going to transform or evolve, I should say, in the next 5 years. A little bit from GPUs taking share, to ASICs taking share. And so we've highlighted that there could be a shift from the likes of NVIDIA's chips, AMD's chips, to Broadcom's chips. Now, we think that there's going to be a massive appetite for all chips, but did want to highlight this share shift as well, much like we highlighted the shift away from SaaS toward platform as a service. Now, this spending, is it justified? This chart, Brett Winton, our chief futurist, prepared for Big Ideas 2026. It highlights the technology revolution investment cycles here. And you can see the railroad in the 1800s. Railroad spending, as capital spending, as a percent of GDP, got into that 5 to 6% range. Then you go to the automobile in red there, but we have multiple platforms evolving at the same time, and this is additive. So maybe with telephone, electricity, and the automobile, we would see capital spending up at that, cumulatively, up at that 5 to 6% range. And then you get to the internet, the tech and telecom boom, and you can see it looks like it pales in comparison to those other two, but we do have an additive situation going on here, and you can see that adding all of those together is maybe the equivalent of just the automobile cycle in the early 1900s. And then here we are. And we believe these are our forecasts, and they have been our forecasts, and we haven't changed our forecast in the last year. But we've got something additive going on here as well that could accumulate to 12% or more of GDP. Now, just to give you a sense of or some perspective, I remember in the bubble, telecom equipment spending on the part of some providers got up to 25% of GDP. And as I always say, too much, too soon. And we ended up with a lot of dark fiber. It didn't go live for a very long time. One thing we can say about this cycle is the demand for GPUs is voracious, and they are landing in these data centers, which are saying, we need more capacity. We need more chips. Those GPUs are not dark. And I'm stealing that from Brad Gerstner at Altimeter. I thought that was a very good analogy. The fiber went dark, GPUs are alive, and there's a big scramble for them. Now, the risk here is, and I have an economics background, and I'm always looking for those risks. Whenever I hear the word shortage, I usually believe that there's going to be a glut, an inventory glut at some point. And I'm sure there will be in the chip space, but I don't think it's going to be for a long time. You need to listen to Elon Musk, who's talking about chips and power as for as far as the eye can see, being in short supply. And now that he's thinking about putting data centers into space, perhaps even more so. So on this next chart, this is getting to investors. So you can see on the left here, the tech sector capital spending as a percent of GDP. And you can see that it has gotten up to bubble days. And that's a little bit unnerving to investors. And here's why. Many of the most seasoned investors today were very young when the tech and telecom bubble took off. And now they are the gray hairs. And I'm friends with a lot of them. And many of them are saying, been there, done that. I'm leading this organization now, and I'm going to protect it from this bubble. And we understand that. But as I just described, we have really just started this journey. And we expect the capital spending cycle to go much further for much longer. And the reason is the technologies are ready. Back in the 90s, we didn't get the cloud even until 2006. But there were visions of, eyeballs in 10 years being the source of valuation today. We didn't get the cloud till, or back then, we didn't get the cloud until '06. We didn't get the first big breakthrough in AI until deep learning, ImageNet, in 2012. Even bigger and more profound, transformer architecture in 2017. And even off of that, we didn't get ChatGPT, the aha moment, until the end of 22, early 23. So we have just begun this journey. Now, one other difference, very important you can see from this chart, is the valuations today are much different than they were at the peak of the bubble. So the dash line there, you can see is the valuation of the Mag 6. And you can see how crazy the valuations did get at a time when the technologies weren't ready and the costs were too high.
Totally.
Speak with not only for Dow 50K and the jump back in tech, but also as the chairman of Bitmine. Tom, I know you're watching what's taking place in crypto. We're talking about a 7-month low for the stock of Bitmine. The Ethereum paper losses, $8 billion. Is this in jeopardy of going into a pretty dark place?
Hi, Scott. Thanks for having me.
Bitmine is designed to be a vehicle that tracks Ethereum prices, but on the upswing, because we're adding Ethereum, will outperform. So Ethereum's in a drawdown. Bitmine's going to be in this drawdown spot. Bitmine has no leverage. It has roughly 4.3 million Ethereum that earns 3% annually, and we have 600 million cash earning about 4% in money markets. So the company is making about $1 million a day. So there is no risk, no need for the company to actually raise money because it's debt-free and actually generates about 360 million a year in net income. I think crypto sentiment is rock bottom because it has been a terrible drawdown. I mean, just the past 10 days, Ethereum's down 40%. And that's triggered, I think, a lot of concerns about whether crypto is...
Okay, let me push back against Tom Lee here. In regards to, by the way, good job of him sticking up for, the company he's obviously involved with there and, kind of pointing out their cash position and lack of leverage and things like that. Bravo to him. Sentiment's at the bottom for crypto when no one wants to talk about it. Still, a lot of people want to talk. Like, I went on X here today. Everybody's talking about the bounce back and talking about like, oh, we were up some, but we're still down so much. Like, I'll give you a good example. Like, obviously, Bitcoin, Ethereum, it kind of bottomed out there end of 2022. No one was even cared to talk about Bitcoin, Ethereum. Like, it was almost like embarrassing if you even try to bring it up, right? Like, don't even talk about it. A lot of people still talking about it, like a lot of people. And so you're usually at a bottom when no one's interested, no one wants to talk about it. And a lot of times the same with a market, if you're actually going through a bear market, usually by the end of that bear market, you're at the end when almost no one even wants to talk about stocks anymore, right? Like everybody's so down and out, they're kind of like over it. Like the crash period already happened. And every time like people thought the market was coming back or bottomed, it just went lower. And by the time you get to the end of it, like no one even wants to talk about it. And so that's what I'll say about that. So sentiment can get a lot worse from here. And, let's say hypothetically, Bitcoin, Ethereum keep trying to play this game of like coming back and then they just go lower, right? And then they come back a bit and then they just go lower. And let's say that lasts all the way to the fourth quarter. By the time you get to the fourth quarter, no one will want to talk about Bitcoin. No one will want to talk about Ethereum anymore. And that's when you'll actually get the real deal Holyfield bottom there, okay? But we'll see what happens.
Bible. But, all of those statements that I just heard from just a minute ago, I heard the same thing in November 2022 after FTX. And that's the reality that crypto is sort of characterized by hypervolatility and big drawdowns. And just in the last 8 years, Ethereum's had 7 drawdowns of 60% or more. The big news is 7 of those were all V-shaped recoveries. So we had a waterfall decline. If crypto's bottoming now, which it kind of looks like it is, especially given MicroStrategy's 25% move, the recoveries are V-shaped. So we recover as quickly as we've fallen.
Just want to follow up on that. Where you suggest there's no risk to the company, is that assumption that Ethereum has stopped going down, that this is a bottom? If there is what some have predicted to be a coming quote unquote death spiral for certain cryptocurrencies, if the situation with Ethereum gets worse, what happens here?
Well, yeah, I mean, it's a fair question. I think we can look at metrics, for instance. If you look at the number of active addresses on Ethereum, it's up 117% versus a year ago. In fact, in just the last 3 months, that's actually gone up parabolically. As you know, coming out of Davos, what was the big story around what Wall Street plans to do? It's tokenization, which is moving a lot of their financial infrastructure onto the blockchain, Scott. That's not going to change just because crypto prices have fallen. But what is the blockchain that is evident, listed, named by whether it's UBS, Standard Chartered, or Fidelity, where they're tokenizing products? It's on Ethereum. So Ethereum is not in a death spiral because the utility is going up. The price, of course, has been awful. Unfortunately, crypto prices are volatile. It's not like earnings estimates change for Ethereum. In fact, network usage is up 80% in just the last 6 months. But it does mean prices move a lot. I mean, it's sort of a feature of crypto itself.
So the most painful thing that could happen here with Bitcoin and Ethereum, and the thing where you really get sentiment to just go awful, is have these bounce backs come, investors pour money in, Bitcoin's back, Ethereum's back, we're going higher, right? Always just be let down, and it goes lower. And then starts to bounce back, and then each time the comeback is weaker because people start doubting more and more and more, right? And then eventually you just get that last just brutal waterfall sell-off, and that's usually when you reach a bottom, right? In regards to at least Bitcoin and Ethereum. And those are really, at least from my perspective, like if you're going to own anything in the space, like, those are really the only two worth owning. Bitcoin is more just from a standpoint of like digital gold, if you want to look at it from that standpoint, right? Obviously, back in the day, people used to talk about, everybody's going to be transacting in Bitcoin. That obviously future has not come. But from like, I get it like a digital gold like perspective, like there's only 21 million ever in that perspective. Ethereum's more of, I think, a use case based one. And that's been a strong case for years. Maybe it's getting stronger now, but the bottom line is you want to create the most pain. Just have every bounce end up eventually going lower, and then people will just be, by the time you get to the fourth quarter, people will not even want to entertain the thought of conversating about Bitcoin and Ethereum.
First top level thoughts about the market today. What do you think is going on?
Happy days are here again. I mean, across the board, everybody's buying, not just stocks, but Bitcoin, gold, and so a lot of asset classes are doing extremely well. And I think a lot of that has to do with all the spending that these hyperscalers are planning to do. $650 billion this year is going to be very, very stimulative to an economy that honestly doesn't really need to be stimulated. We also have refund checks that are coming that are going to be very large.
Yeah, it's amazing to contemplate. So here's what's ironic. So Amazon shares are down 8%. Our guest last hour said, yeah, they're a little behind as far as he's concerned and need to spend this $200 billion figure to catch up. The rest of the market is cheering. NVIDIA's up 7%.
Exactly.
Everything in the AI value chain is like, great, we're thrilled. Glad to hear it.
Nobody's talking about a recession, and the only question is how big a boom are we going to have from all this?
Right.
Yeah, the Atlanta, what is it? The Atlanta GDP now, I know it fluctuates, Ed, but it's showing about a 5% GDP growth. And I think you're touching on a really important topic because we like to keep things simple here. We say, okay, Meta or Amazon is spending $1 billion on a data center. What we don't talk about is that there's probably 500 to 1,000 vendors, different companies inside of every.
So Trump, I always like to look at these things as objectively as I possibly can, right? As somebody that doesn't vote for the political party, if you watch my channel for years, you know that, right? I just look at it as like, from their different standpoints. Trump is getting a lot of what he wants in terms of trying to create a very strong economy and economic backdrop for the next 3 years. He's getting companies, all these big tech companies, to spend a fortune over the next several years, right? Which is, once again, very stimulative to the economy. He's getting a situation where with the big, beautiful bill, that should really start to impact in a positive way the consumer as well. He's also getting inflation to stay at bay, which is something very important because it's like, okay, let's say the economy is really strong, but inflation's out of control, and you got 5, 6, 7, 8% CPIs. Are you really doing any better? No. But if you can keep that CPI under 3% while you have an economy that strengthens considerably, now we're talking, right? Now we're talking about an economy where people feel great again, right? And you see, for the last several years, the consumer sentiment's been about as bad as you've ever seen. If you want to talk about fixing that consumer sentiment over the next 2 or 3 years to get a great consumer sentiment again, have inflation be dead while the economy is extremely strong, and you'll see those sentiment numbers skyrocket from here essentially and get back to where they were kind of in like 2018, 2019 before you obviously had the Rona crash, right? So now the last component Trump is trying to get, we'll see if he's able to get it, but Trump wants to get housing moving. And the only way you can get housing moving, there's two ways. One is the economy much stronger, but that's not really the way. You got to get mortgage rates lower, right? In order to get mortgage rates lower, he's really got to get that 10-year lower. But the problem is if you have a strong economy, then usually there's fears about inflation. So to get that 10-year a lot lower is a difficult challenge. So he's been able to do quite a few things that you want to do if you're going to try to set up a really strong economy for the next 2 or 3 years. But that last component, that's going to be difficult. If he can do that, then you can talk about the real estate market's also moving, and then you got an overall great economy. If you get real estate moving, plus jobs are there, wages are strong, right? Overall spending's good, and inflation is, in a lower place, let's just call it. Banger, right? You got a banger for 2 or 3 years. We'll see if he pulls out the real estate one. That one I'm really, really intrigued with. That might be the biggest challenge of all.